Hiram, you are on mute.
Hiram, you're not audible.
You're not audible, Hiram.
Am I audible?
Yeah, yes.
So good evening, all my dear CA aspirants joined from Pan India. Firstly, I am thankful to Pune Vikasa for giving me such an opportunity to be MOC for today's session. I am Hiram Deshmukh, your host for today's session. It gives me immense pleasure to extend you all a warm welcome on behalf of Pune branch of Vikasa of ICI, jointly with Ahmednagar, Akola, Anand, Chhatrapati Sambhajinagar, Dhule, Goa, Jalgaon, Jamnagar, Nanded, Navsari, Navi Mumbai, Pimpri Chinchwad, Sangli, Satara, Surat, Vadodara, branches of Vikasa of ICI and Cuttack branch of Vikasa of ICI, who clubbed all of us for the seminar session on the key highlights of foreign trade policies FTP 2023. I welcome our speaker, CA Shailesh sir, for today's session, and also our Pune branch chairman, CA Sachin Miniar sir, and our team Pune Vikasa. I request CA Sachin sir to enlighten us.
Thank you, Hiram. Good evening, everyone, and welcome to our program on the new foreign trade policy 2023. Today, we are here to explore the various aspects of foreign trade policy and its implication for business and global economy. Friends, an analysis of India's foreign trade statistics shows that international trade has risen by 15% on a year-on-year growth over past 10 years. And this is a big figure. As per official data, our exports is worth $453 billion and our imports is to the tune of $723 billion in the calendar year 2022. So our overall international trade has reached $1.17 trillion. It's a huge increase of 21% over previous years, $969 billion overall international trade. For the first time, India's international trade has crossed 1 trillion mark, and this is a worth commendable thing. But there is one more other side to this 1 trillion international trade that I am telling you. This has also resulted in a record high trade deficit because our imports have been much more as compared to our exports of goods and services. Well, what does foreign trade policy play a role over here? Rather, foreign trade policy has become an essential part of the global economy landscape, with countries around the world engaging in cross-border trades to foster growth and development. We know we have been trading in China, US, countries from Europe as well, all over the world. So there has to be some standard policies based on which these imports and exports are done. So as students, you have this unique opportunity to learn about the complexities of foreign trade policy and how it shapes international relations, trade flows, and economic growth of our country. So throughout this program, we will hear from our today's expert, his insights and experience on the topic. At the end, we will also have an interactive session. So in case if you have any queries, I would suggest you that you post in the question and answer panel or maybe the chat box, and Hiram will take all these queries along with our expert at the end of the session. I hope by the end of this program, you will have a deeper understanding of the importance of foreign trade policy and how it affects the world around us. So thank you for joining us, and I wish you an enriching learning experience. Over to you, Hiram.
Thank you, sir, for your such a valuable words. Now, I would like to introduce our speaker for today's session, CA Shailesh Rathi, sir. Sir has been fellow member of ICI since 2006. Along with CA, sir has also pursued BCom, MCom, and CS. Sir is certified with IFRS Professional from ICI, also certified with a valuation course and indirect taxes. Sir started Rathi and Company Chartered Accountants in Pune at 2012, specialized in corporate indirect taxes and foreign trade policies. Not only this, but sir also assisted several multinational clients to get various schemes like MEIS, road tape, etc. And also, sir represent multinational clients in front of government authorities and regulatory authorities. Sir also helped various clients to get GST refund in shortest possible time with his experience in indirect taxes. Sir has worked with Deloitte. Sir has worked as assistant manager at Deloitte Pune for 1.5 years and as a partner with mid-sized CA firm dealing with the numerous assignments like related to accounting, audit, and regulatory compliances. Sir has also been speaking about GST and foreign trade policies at various sessions conducted by ICI and MCCIA. I would like Shailesh sir to continue this session forward. Thank you.
Well, thank you, Iram, for introduction. Thank you, Sachin sir, for enlightening us with the prerequisites of a foreign trade policy and how it helps growing the business over a period of time. It has grown, like you rightly said, it has grown to 1 trillion, and now the government target is to make it at least 2 trillion by just and with an exports. So foreign trade policies plays a vital role while deciding all these numbers, how to achieve. Basically, foreign trade policies is a roadmap to achieve all these numbers, which Sachin sir has mentioned, and otherwise government is planning or government is targeting such numbers. So foreign trade policy helps them guiding. This plays a guiding principle for achieving these numbers, these 1 trillion, 2 trillion, the way forward to it. Which product will give us a good revenue, which product will give us a good earnings. So all these is generally decided or generally is a playing factor by foreign trade policy. So we'll briefly discuss what is the importance of foreign trade policy, what are the changes has been made in a recent time by government in foreign trade policy. So welcome you all for the learning session on the foreign trade policy. I'll just share my screen. We have a is it visible?
Yeah. Shailesh, it's visible.
Full screen?
Yeah, full screen.
Okay, thank you for confirming. So foreign trade policy 2023, and we will be governing just not the foreign trade, the changes in foreign trade policy 2023 will be also covering various things which were into existing policy and which are getting carried forward to the new policy. We are just not covering the changes. We are also understanding the what was there in the earlier policy and what is expected from the new policy. So that will set a right tone, or that will set a right kind of understanding about the changes which the government has made in the recent policy 2023, which is effective 1st April 2023. So the intention of the government is very clear. They want to have the maximum revenue from the exports. As Sachin sir rightly mentioned, though we have grown our export, though we have grown our imports, but it is ultimately resulting into a trade deficit. So the trade deficit should be reduced to the maximum extent, and we should be self-sufficient in terms of foreign currency reserves. But for that, the export should be rising on a continuous basis. Then only we'll be able to achieve these numbers or trade positive numbers. So the foreign trade policy will be the governing factor. So in today's session, we will understand what exactly the foreign trade policy, the legal framework, the new foreign trade policy 2023 approach, what is the duty exemption and the remission schemes which are currently in place and which government is planning to introduce in near time, or which has already been introduced in the past couple of months. Then streamlining the SCOMET policy. So this is again an important aspects to consider while deciding the exports. Then merchandising trade. There are some amnesty schemes introduced by government, and other important policies, rules affecting the foreign trade policy. Though these are not part of foreign trade policy, but as a consultant or as a student, we should be aware of other important aspects which somewhere directly or indirectly correlating to the foreign trade policy. So these are important aspects, or these are the content which we will be covering in today's presentation. So if you have any doubts, any queries, you can please note it down, or you can just submit your concerns, queries in a chat box. So we'll try addressing all your concern queries towards the end of session. So first is what is foreign trade policy? Well, foreign trade policy refers to the set of guidelines, measures adopted by government to regulate its trade relations with other countries. So, uh, many times, maybe with Russia, you may have seen that you are not allowed. The U.S. government is not allowing to be import happening from Russia. Even the various government has put in some certain restriction on the import export with Russia. But how does that happen? So these foreign trade policy helps you defining the rules, with defining the trade barriers, with which country you should trade, with which country you should not trade, which country you should be you should sell or purchase either of. So how the government gets a power? It is through a foreign trade policy. They have the powers to control the foreign trade. So many times you may have seen that the onions are banned to be exported, or maybe the sugar is banned to be exported to Pakistan or to a specific country, or even in general the product is banned to be exported. How the government gets power to regulate such kind of things? It is the foreign trade policy. Through foreign trade policy, government can regulate all these activities. So government takes care various consideration while deciding on these factors, that number of the production happened during the year, the demand which is there in India for the product which is to be exported or imported, how much supply is available, how much is demand is there, and also the product pricing. By considering all these parameters, government or the Director General of Foreign Trade decides the whether this particular product should be allowed to be imported or not to be allowed to be imported, or allowed to be exported or not to be allowed to be exported. So this is a governing factor which is very important while uh, deciding the pricing. Because if you allow continuous export and there is no sufficient production has happened, let's say, for the continuing the example of onion, if there is a no production of onion, which cultivation has happened in India, and you're still allowing export of onion, obviously the prices in India will shoot up, and that will result into higher inflations in India. So to avoid that, government has kept such kind of powers with them, so as to control appropriate pricings as well. Who has the power to control this? This foreign trade policy comes under the Ministry of Commerce and Industry. Please note, this is Ministry of Commerce and Industry and not Ministry of Finance. So foreign trade policy, though it has the finance implication, but it doesn't govern it. It is not governed by Ministry of Finance. It is governed by the Ministry of Commerce and Industry. So generally the policies, every 5 years government issues the new policy. The existing policy which was there, which was for the year 2015 to 2020, because of COVID it got extension till to March 2023. Now the new policy has been introduced effective 1st April 2023. But this year the major change government did is, this policy is not applicable just for 5 years. It is issued without any time limitation. So this is just not 5 years. So far, all the policies which were issued were all policies were for every 5 years. The government used to issue the new foreign trade policy based on the future projections and the future plans of the government. But this first time ever the government did is, there are no time limitation for this policy. However, there will be continued modifications in this policy as and when required. So government will keep on interacting with industry, keep on interacting with the export promotion councils, and will decide the way forward for all these activities. And will keep amending the policy 2023. And this is like, note that there are no time bounds. Well, the main object are to promote export, increase foreign investment, improve the competitiveness of the domestic product, and stimulate overall economic growth. This is the purpose of the policy, as I mentioned even in my earlier earlier, that this helps you regulating the pricing, increasing the foreign investment, improving the exports, getting the maximum foreign currency in India. So this is the sole purpose of having the policy. Well, function of a policy or the function of FTP or the DGFTs are to facilitate foreign trade, then implementation of various policy regulating trade such as foreign trade policy, licensing authority for exports, imports, and exports and import businesses. So what licensing, in the sense there are few products which are banned or which are not allowed or which are allowed by permission. So government wants to regulate such some kind of product uh, which will be imported. So uh, currently drones are not allowed to be imported freely, but drones can be imported with a permission. So government wants to know which companies are importing drones. So drone is one example. Similar, there are numerous products which are to be imported. So drone is one of the example. So if government wants to have the restriction on the import, so government would issue the licenses to be imported. Same way, if some products are banned to be exported, then it can be exported with licenses. So DGFT or the foreign trade policy has a rules to issue the licenses for import or export as may be required. Then, as I already mentioned, the prohibit, restrict, regulate exports and imports. Any products which has some challenges in Indian government feels that it should not be exported, otherwise it will imbalance the demands or supplies in India. Then government will have all powers to export, allow or disallow import or export of a particular product. Then implementation of schemes like advance authorization, EPCG licenses. So there are few schemes, or by using such schemes, you are eligible to import or export the material without payment of duty. So what exactly that advance license and EPCG license? We will look for that in a latter part of the presentation. For first and foremost, generally the importer exporters needs to have is the importer exporter code. So this is an I normally known as a IEC. So this is in one of the prime number. Likewise, the PAN is there. So any exporter or importer should have an importer exporter code. That's a mandatory code which any importer exporter should have. Without that, you are not permissible to trade or to import or export. So generally, we have seen that many service-oriented industry don't have the IC. So one should ensure that even the service industry is mandatory to have a import-export code. So import-export code is a 10-digit code which is given by issued by DGFT. Nowadays, PAN is as good as your IC, but there is a separate registration required with the DGFT authorities, so as PAN gets gets a link to the DGFT portal, and you're able to import and export the material. So in case of import or export of material, the courier agency or the airport authorities or shipping bill customs authority ensure that you have the import export code. However, in case of service industry, the import export code is generally not being taken, but however this becomes a non-compliance as per the RBI regulations and the DGFT regulations. So one should ensure that every company who is involved into either import or export, either of goods or services, one should have an importer exporter code in place for your client or for the company who are into these kind of activity. Now recently, last year, government has made one change to this policy, that every importer exporter code has to be renewed or revalidated every year with your KYC document. So every company who has an importer exporter code needs to renew their IC by submitting an online application with the DGFT authorities. So you get your importer exporter code updated. If you don't do it before 30th June to 30th June, then your importer exporter code will be deactivated and you will not be allowed to import export the raw material, import or export, do the activities of import or export. And then if it is not done, then it is subject to, then again, some penal consequences. You will have to pay some penalty to the government authority and then have your IE's importer exporter code revalidated. Then structure of new foreign trade policy. The foreign trade policy 2023 incorporates provisions relating to exporter importer effective from 1st of April 2023. This shall be continued to be operational unless otherwise specified or amended. So as I mentioned earlier, so this policy is for long period unless otherwise government decides some end date to it. This policy would continue to be in operations. In FTP, the changes would be done subsequent to the initial release, even without announcement of the new foreign trade policy. So government will keep on amending this policy based on the requisites. So it's a dynamic and emerging solutions would be evolved, and those will be notified without changes in the foreign trade policy. So there is no foreign trade policy would be done. The foreign trade policy is a document based on the time-based schemes are there. So what are those schemes we'll see in the next part of the presentation. So this policy would keep on interacting with the trade and industry or the ECPs, the streamlining the processes and update the foreign trade policy from time to time. Well, what are the pillars for the new policy to FTP 2023? That is, firstly, we are moving from the incentive mechanism to the remission mechanism. What exactly that means, we'll see to it. Then export promotions through collaboration of exporters, state, district, Indian missions. So this is something which government is doing innovatively, or government is trying to do. One district would be assigned with a specific product, and government will channelize all its agency, that is state, district, or the collector office. Everyone would operate in the same direction to ensure that that particular district exporting that particular product for which it has been nominated for. So government is trying to do it innovatively. So one district is equal to one product. In that way, the government is interacting by using the Niryat Bandhu scheme. What exactly that scheme is, again, we'll see the latter part of the presentation. The ease of doing business, reduction in the transaction cost, and e-initiatives are there. So government is now moving everything in an electronic mode. Still, even today, the licenses which are issued by the Director General of Foreign Trades, are few licenses still gets issued physically. So government is completely moving that on a electronic way. E-initiatives have been in place. Here onwards, all the licenses, whether it's a new license or amendment to old license or even redemptions of license, would happen only and only by using the e-media, electronic medias. Then emerging areas like e-commerce development, district as an export hub, and streamlining the SCOMET policies. So what those are there, we'll see in the latter part of it. So these are the important pillars of the foreign trade policy, on which the foreign trade policy have been drafted or have been placed effective 1st April 2023. Well, we are moving from the incentive scheme to the remission scheme. So earlier government was giving the incentive for exports. So now, so like there was a scheme called Mercantile Export Incentive Scheme, or the Service Export Incentive Scheme. So these kind of incentive schemes were there because you are into exports, but these policies were not in line with government's, the World Trade Organization's policies, or the World Trade Organization has some agreements with Indian government, with every country. So that giving incentive for export was violation of those agreements. So government has moved from the incentive scheme to the remission scheme. So remission is nothing but every government or no government wants to export the taxes. So there are various taxes which gets embedded in your product. So that includes the electricity duty, or maybe the local body taxes, or the state levies. Maybe some petroleum products are used while delivering the group goods like petrol, diesel, oil. So all these gets used during your manufacturing process or delivering process. So all these gets directly or indirectly embedded in your cost. So no government want to have the export of all these products, all these taxes outside India. So government is giving, and there is no mechanism to currently there is no mechanism to claim all those duties from government. So government is giving you a special scheme called remission scheme. So remission of duties and taxes on exported product. So now commonly also known as a RODTEP, RODTEP, RODTEP. So this includes all these duties gets reimbursed for a exported product. So let's say you are into export of a export of some machines. So while manufacturing a machine, you may have spent on the diesel, on the if you have the premises in a Pune Municipal Corporation limit, you may have spent money on the by paying the PMC taxes or the local body taxes or the uh, storage taxes. So there are kind of various taxes which have been paid. So all those taxes are somewhere embedded in your machine. So government will give you, based on government's analysis, government has decided certain rate for the each of the product. So government will give you that kind of money back from cash back from the government account. So this is a kind of a remission and not the incentive. Incentive is something which you get without any consideration, which you get without any obligations. Whereas this is pre-decided based on some mechanism, based on certain parameters which government did some analysis for deciding the rate on the road tap. So every person who is into exports are eligible for getting the duty back, the remission of duties and taxes from the exported product. Well, this is something which is over and above the tax, the duty drawback rate. So government has, so there is something called duty drawback. So if you are into import, if you have imported some product and you are exporting the same product, you are eligible for duty drawback on a pre-decided rate. So this is duty drawback is also there, and this road tip is also there. So duty drawback is one scheme, and that road tip is in excess of the duty drawback scheme. So you're eligible for both kind of cashback from government account. One is governed by the Customs Act, whereas the road tip is governed by the foreign trade policy. So same way, likewise, the scheme is governing the products which are related to other than textile. So for textile, government has issued a specifically uh, ROSLT. There is a scheme, so remission of state and central levies on export of garments made of products. So this is specifically issued by the Ministry of Textile. So this scheme, similar way, likewise the road tip scheme is there, exact same replica of the scheme is there, but this is governed by the Ministry of Textile. So this is again an incentive, remission scheme by respective government for the export of garments and its made product. Well, so government, as I mentioned, government is wants to move from 1 trillion trade to 2 trillion trade, but how it will move. So government is focusing on the district as an export hub to boost the Indian foreign trade by decentralizing export promotion. So government, what government is will do is every state, region would be treated as a one export hub. Let's say Pune would be treated as a auto cluster. So it would be promoted for the auto ancillary or the auto product export hub. Likewise, even maybe Aurangabad or the maybe Sambhajinagar would be treated as a export hub for the sugar belt. So every district would be governed by some export product would be assigned, and entire government machinery will focus on boost of the foreign trade for that particular district. So it is decentralizing the export promotion. Earlier, all the promotions, all everything, all decisions were made from the head office in Delhi or the regional office of the Director General of Foreign Trade. But now the government want to decentralize it to the respective country or the respective districts. So district administration will take care of the export. So the capacity building would be there, creating new export and identification of the new market would be done. Then if you have a specific export hubs, so all people in that region would be given training, given handholding in that particular field. So there is a complete ecosystem which gets developed automatically in and around that city. So let's say Pune is developing as an auto hub. So most of our so government focus would be training people how to manufacture the auto ancillary components which are required, or the OEM components which are required by this auto companies. There will be sufficient jobs would be available within the same region who are the expert into this domain. So government has given some roadmap, but the result of that would be entire ecosystem of the entire this hub would be developed as an auto ancillary hub automatically once there is a focused way of doing the business happen. So in my region, if everyone is working on a auto ancillary, automatically my surrounding people would be expertise into this particular domain as such. So government has given guidelines. So rest of the things will flow automatically by training, handholding, and outreach program, which will be carried by DGFT in consultation with the DICs. Then regional authorities of DGFT working with the state union territories to prepare the district-specific export plans. So government has given these powers to the DGFT authority. Then export promotional outreach program would be carried district focusing branding, packing, designing, marketing, and identification of product and services that would happen over. Then promoting export through e-commerce. This is something which is currently government is not through e-commerce. If some trades are happening, so there are no benefits which are flowing to foreign trade policies. But now government has introduced e-commerce platforms are also eligible for incentive under the foreign trade policy. The consignment-wise cap for the e-commerce exports through courier has earlier through courier maximum material which was allowed to be exported was only 5 lakh. Now with the new policy, it has been increased to the 10 lakhs. Now integration of the courier and postal exports. So there is a portal called IceGate that monitors the import exports that monitors and that is a electronic platform for importer and exporter. So even the courier and the postal exports would be monitored through IceGate now. So far, it was not monitored through the IceGate. So now government has in plans to start using the IceGate effective 1st April 2023. Then e-commerce hubs to create for facilitation all operations at one place, and the setting up the dark Ghar Niryat Kendras. So government wants to promote the postal exports more. So government earlier it was like only the few courier companies which were exporting material. Now even our post offices will be are eligible to be export. So all the post offices now would work as a Dak Niryat Kendras. And there is a scheme called Niryat Bandhu scheme, which is introduced by government. So this is again a outreach program by the government where anyone who wants to export, start export, they can reach out to the DGFT authorities. They'll have the mentorship program. They'll guide you. Counseling would happen. Training program would happen. How to do the export. So this is something Niryat Bandhu. Well, this is like more to do with the fundamentals of the policy. Now coming to the actual implementation of the policy is concerned. So there are mechanism how the government is planning to, as I mentioned earlier, the government wants to move everything digital. So government is planning to make it digital without any hassle. So earlier there was like processing time were there, current processing time were like for advance authorization Currently government was taking 3 to 7 days to process it. Now it has been reduced to 1 day processing. Then the EPCG licenses were taking 3 to 7 days. It will take 1 day. Revalidation of the authorization used to take 3 days to 1 month. Now it is to be 1 day. So all these would be automatically processed. There are no manual intervention. You need to make an application. The government end will only see whether any there are like malpractices or there are any illegal kind of products which are getting licensed. Otherwise, all these licenses will get issued within 1 working day. So there'll be automated process to it. Now, the application fees have also been reduced to drastically. So close to 55 to 60% exporter who are currently MSME would get benefited out of it. So currently, the licenses which are for about 1 crore, they'll be paying only 100 rupees as their license application fees. Whereas if it is 1 crore to 10 crore, then 5,000 would be paid. So the fees have been drastically reduced to a great extent. So there are two kind of schemes now. Coming to the schemes which are related to the objectives are advanced authorization, the EPCG scheme commonly known as. So advanced authorization scheme helps you getting raw material without payment of duty, provided you have the exports or export of that particular or similar product. Then export promotion of capital, EPCG helps you import of capital goods. So advance authorization is one scheme where you are required to import the raw material without payment of duty, whereas EPCG helps you import of a capital goods without payment of duty. So without payment of duty, in where it means there are, while importing you are liable to make a payment of custom duty payment, anti-dumping duty payment. You are required to make a IGST there. So all these payments are no more required to be paid while importing the raw material or capital goods, provided you have some export obligations. So government is expecting you to give some kind of commitment, and in return, government is allowing you to import these raw materials and capital goods without payment of any duty. So there is a scheme called Advanced Authorization Scheme. So this allows you import of raw material which are physically incorporated in an export product. So requirement is what? There should be import of input that should be available in the product which is getting exported. So government is expecting you import the raw material without payment of duty, but obligation is you should be exporting by manufacturing that process. So import, process, manufacture, embed that product in one of, use that raw material as in your manufacturing process, and then re-export. So if you're into this kind of activity where import is happening, processing is done, and then export is happening, in that case you're not allowed to you're not required to make any kind of custom duty or the anti-dumping duty or the IGST payment as such. Fuel, oil, catalyst which is consumed, utilized in the process of production, export may also be allowed under the advanced authorization. So during process, it may happen that there are few components which are getting used as an entirety. So there are no so it is not getting actually attached to the material, but however it is getting consumed during the process. These material can also be imported, like normally known as a consumables, can also be imported without payment of duty. Then there are advance authorization issued with zero rated duty. It can be issued either to a manufacturer exporter or merchant exporter tied to the supporting manufacturer. It need not be you yourself making an export of product. It can be you can do the export with your supporting manufacturer. Still, you are eligible for getting the benefits under the advanced authorization scheme. Well, what is the condition? There should be minimum 15% value addition should be there. In case of spices, minimum value addition should be 25%. So what do you mean by value addition here is, like if you have imported material worth of rupees 1 lakh, so the product should, there should be some value addition and the entire product should be sold for at least 100 and 1 lakh 15,000 rupees. Then only it becomes a eligible product. So if the value addition is only 5-10%, then government is not allowing you to be import under this scheme. The export obligation should be completed post import of input. So like first you cannot export and then import. Firstly, you'll have to import, process, and then export. So the products which are the product which are exported earlier, you are not eligible to take the benefit of that. So the process is firstly import, manufacture, then re-export. So that's the condition. So there are standard wastages are there. Like if you import some material, it need not be the 100% which is getting used in this process. So there are it may happen like 5-10% there will be wastage towards it. So the normal wear and tear, or normal wastage is very well permissible within law. But if there are more wastage, in that case, you will have to approach to the government to fixation of the standard input or output norms. So it is commonly known as a SION, that is standard input output norms, which is fixed by the government agencies or the Director General of Foreign Trade. So as per SION norms, you are eligible to import. There are permissible wastage which gets defined, and then you can export. So standard input output norms are defined, and then based on your actual user, the government allows you the wastage percentage on the higher side. So normally, normal wear and tear, normal wastage is very well permissible. But if your product is having more wastage, then you need to approach to the government and get your wastage approved from the government authorities. Then the special advance authorization scheme extended to the export of apparel, clothing sectors, self-declaration basis, prompt execution of export orders norms would be fixed within fixed time frame. So currently there are no time frames to the fixation of the SION norms, but the government is saying that special advance authorization scheme for apparels and clothing is introduced, and as per that, the SION norms should be fixed within the specified timelines as such. Then for two-star exporters, the AEO exporter, the self-ratification scheme for the SION is extended. So what is AEO and what is two-star exporters, that we'll see in latter part of the presentation. But the self-ratification schemes are there for these kind of products, these kind of entities like two-star exporters or the AEO, that is authorized economic operators. Well, coming to the next part of the presentation, that the first is governed by import of raw material without payment of duty. Now coming to the next kind of remission or next kind of benefit which is governed by this policy is the EPCG, that is export promotion of capital goods. So as per this policy, you can import the capital goods. In advance authorization, you are eligible for the import of raw material. In EPCG, you are eligible for the capital goods. So in this policy, you can import the capital goods without payment of duty. Now there are some conditions attached to it. So you are eligible to procure the machinery or the capital goods for pre-production, for the production, or for the post-production. What are the duties which are exempted? Basic custom duties exempted, safeguard duties exempted, transitional products specific safeguard duties are exempted, anti-dumping duty is exempted, and IGST is exempted. So basic custom duty, safeguard duty, and all these duties are exempted from the specific exempt. So there are you're not required to make payment of any kind of duties to the authorities while importing the capital goods. Then export promotion of capital goods. So there are conditions attached to it. So government will not allow to do when government will not allow you to import the capital goods without any further obligations. So government is saying that you are eligible to take the benefits of this scheme provided you export at least 6 times of the duty saved amount. So if you have saved some duty, so you are required to do an export obligation of 6 times of the duty saved. So by we will see what exactly that how the calculation works in the next part of next 1 or 2 slides. Then the EU has to be the export obligation has to be fulfilled within 6 years. So if you have imported material today without payment of duty, you are required to export products which are manufactured using that machine over a period of next 6 years, 6 times of the duty saved amount. So how the calculation work, that we will see in the next slide. So authorization validity is for currently it's 18 months, which has been issued for which has been extended for the 24 months now. Instead of 18 months, once the license is issued, you can import that machine within 24 months from the date of issue of this license. So EPCG schemes cover manufacturing exporters with or without supporting manufacturer. So it is likewise, you can tie up with the merchant exporter, you can tie up with the supporting manufacturer, and they are also eligible to import the under this scheme. There are two kind of export obligations, but one which needs to understand the logic behind it. I'll tell you. So you are currently, otherwise also you are into export of some some material, and you are bringing a new machine. Because you are importing new machine, obviously your capacity towards export will increase. Your capacity towards export will go on a higher side. Uh, so government is saying whatever the export you are currently doing, that much you will have to otherwise also do. But because you have imported machine, your capacity has increased, so you will have to do an export over and above average export. So over and above average export, what is the average export for past 3 years, that would be calculated. You are required to maintain that average, and over and above average, you are required to maintain some specific export obligation. How that works is, let's say, using this example. Let's say you are into export of some material, and that material you are importing. You have an export obligation worth of rupees 100 lakhs. For last 3 years, every year you are exporting 100 lakhs. So this is otherwise also you are doing, whether you import this machine or no, irrespective of that, you are required to maintain. Otherwise also you are doing. So this is likely to be continued in the next couple of years as well, without even if you don't purchase this machine. So now if you are purchasing this machine, the duty saved thereon is, let's say, 150. That is duty saved. For a sake of calculation, for simplified calculation, I made it 30%. So duty saved is 30%, that is 150. So you are required to maintain export obligation of 6 times of the duty saved amount. So six times is 900. So 6 times of 150 becomes 900. So you are required to export goods worth of rupees 900 lakhs over a period of next 6 years. Now again, 6 years is bifurcated to two parts. First part is first 4 years, the other is next 2 years. So over a period of next 6 years, you are required to do export worth of rupees 900 lakhs, of which 450 lakhs can be done in the first 2 years. Sorry, first four years, and the next 2 years you can do 450 lakhs. Please note this 900 lakhs has to be done over and above this 100 lakhs. Here you are required to export 100 lakhs every year as average export, and extra turnover above 100 lakhs will be treated as a 450, will be reduced from 450. So every year 100 is confirmed. Over and above that, whatever is there, that would be reduced from 450 lakhs. So I hope I'm clear in terms of giving you clarity on what exactly, how does the calculation work. The calculation is 6 times in 6 years. That needs to be understood clearly. If you have any doubts, we can discuss maybe in whenever the Q&A session would start. So then there is another. So this is like EPCG scheme is there. Then government has textile and apparel park has special scheme for common service provider. So government is planning to have a specific like in a textile industry. Yarns are there which are specific. Not everyone can start a yarn. So government is saying you are eligible to use the common services, and even the common services provider is eligible to import the raw material, capital goods under this scheme. Then dairy sectors are exempted from maintaining the average exports obligation. Likewise, we see in this 100 every year is not possible because in dairy product, the primary is the raw material is dependent on the uh, the milk. If there are no production in the milk, likely the reduction in the export would happen. So government has exempted dairy sector from the maintaining the average export, so as they should be able to upgrade to the newest technology. Then battery electrical vehicles are now eligible for the reduced obligation. So if you are into battery electronic vehicle manufacturing, in that case, it is not like 6 times of the obligation. There will be reduced rate of reduced rate would be there. Instead of 6 times, it may be 4 times or 5 times. But government is yet to confirm on how many times the exporter is required. SCOMET policy is there. So SCOMET stands for Special Chemical Organism, Materials, Equipments, and Technologies. So all these products are governed by all these kind of all these industry equipments technologies are governed by this particular product. This particular policy. Currently, government is having special permission required for exporting any kind of product from these industry. So government is planning to make it very simplified version of it, where you can make an online application and the government will process all your applications in a simpler and faster way. The policy aims to make it easier for the industry to export goods such as UAV, drones, chronic tanks, and certain chemical by specific license processes. So government is trying to exclude few products from the SCOMET policy, and also issue the licenses in a shorter time. So government your industry is able to export the material in a shortest possible time. So FTP 2.0 aims to make it India is more competitive player to global market at high-end goods and technology. Likewise, there are district-specific schemes are there. District as an export hub is there. So now there is a similar kind of town of export as excellence is also one of the scheme which government is recognizing. So town, any town which is producing goods minimum value worth of 750 crores would be classified under the TEE, that is town of export excellence. So if let's say Varanasi is producing some handloom product worth of rupees 750 crores every year, then that Varanasi would be considered as a handloom or the handicraft hub. So government will have all their schemes extended. They'll have more focus done on that particular town to ensure the appropriate measures are taken to promote that particular town. So currently there are 39 towns which are notified, and this government has included additional 4 towns in this that includes Faridabad, that is to promote apparels, Muradabad, that is to promote the handicraft, Mirzapur, that is to promote handmade and carpet and daris, and Varanasi is for handloom and handicraft. So these are the four new towns which are added to the town of export excellence. So government is extending them extra additional benefits, or the extra additional market survey schemes are there, market access initiatives are there. Those will be given to these specific towns, apart from uh, other 39 towns which are already notified. Now coming to the status holder certificate. Now, status holder certificate is something which is given as an award, or which is given as a leadership award for your international trade who are doing excellently well or contributing to the country's foreign trade. Then it's just not award. There are numerous benefits which gets allocated to uh, these kind of star house who are regularly involved into export. So currently, the export obligations, which based on the export obligations, you have been given awarded with the stars. So if you have exported more than 3 million, you are eligible for 1 star. Now revised limits are here. So revised limits have been reduced to a great extent. So the people who are into this bracket can get themselves registered for the status holders, and then reduced cost of transactions are there. So what are those there? What are the benefits of being a star house export, that we will tell you in the next slide of the presentation. So 1 star is someone who is exporting 3 million USD in a year. So it is eligible to be awarded with the 1 star. 2 star is like 15 million. Anyone who is having 15 million turnover, 15 million USD is eligible for 2 star. Likewise, 50 million USD 3 star, 200 million USD 4 star, and 5 star is 800 million and above. If one is having, then he or that company is eligible for the 5 star award. So what are the benefits of the having the recognition of the star? It is the exemption for the furnishing bank guarantee. So while importing of a material, government is required. Government wants you to submit various bank guarantees. So you are exempted from the companies who are holding the status holder certificates are not required to give any kind of bank guarantees to the government. Then priority in fixation of the sign norms. The sign, as I mentioned, the standard input or output norms are there. So those would be fixed on a priority. Otherwise, there are no time limits for the government to decide on the sign. But with the, if you are a status holder, in that case, government will decide your sign within a shortest possible time. Then authorization, the custom clearance granted on the self-declaration. Since you are contributing towards the growth of the growth of the country by exporting huge amount, government is giving you concession based on self-declaration only. You can uh, export the material. Otherwise, custom clearances would inspect your vehicle, inspect your product, which product you are exporting, how you are exporting. So you are eligible to get the faster clearance. This helps particularly in case of perishable item, in case of having the shorter shelf life products. These are eligible for the uh, this is like very much specifically helps them to achieve the shorter turnaround time for the export. So status holder certificate helps all these kind of activities in general. Then permission to establish export warehouse, etc. So you are eligible to maintain your export warehouse at a port is very well possible. Uh, so that is permissible without any additional effort or additional. Then merchanting trade is something which is a new concept which government has introduced into the scheme, that includes you. Let's say you are sitting in Mumbai, uh, and there is A is London and B is sitting in Singapore. The material is directly moving from A to B. however, you become a agent kind of thing, which helps A and B to trade. But in this entire case, A can bill to C, and C can further bill it to B, and without actual movement is happening through Mumbai. The actual movement would happen between London and Singapore directly. We are just a bill to and ship to party. So if we are just a bill to ship to party, these kind of transactions were earlier not governed by foreign trade policy, but with this introduction of this scheme, you are very well legally do these kind of activity where movement of goods is happening outside India without getting involved. Indian port, even if the Indian port is nowhere involved, you are still eligible to export the material outside India, directly bill to ship to transaction kind of thing happen. Then there is a one amnesty scheme which government has introduced. It is in line with the Vivad se Vishwas. So like instead of making some sorry. So Vivad se Vishwas, instead of fighting or instead of creating some litigations, it's better it gets settled. So there are like various companies who have imported advance authorizations or using the EPCG and advance authorization, they have imported the raw material or they have imported the capital goods. However, because of some reason they have, or because of there were no export orders, they could not complete the export obligations which government want you to do. So in case of raw material, you are required to export the same product with a value addition of 15%. Whereas in case of EPCG, you are required to export at least 6 times over a period of next 6 years. But all this one could not do because of various reasons. No export orders, or the export order, the machines which you have imported is not giving the quality which your vendor or your customer wants. All the because of some reason you could not do the export of material which is intended to be exported. In all this scenario, government is saying just pay us 100% interest and the basic custom duty which you have saved. So once you pay us the custom duty, basic custom duty has to be paid. There are no exemption from the basic custom duty. However, the interest should be 100% on these exempted duties. So interest is payable is capped as 100%. Otherwise, what happens in case of particularly EPCG? So anyone who is waiting for 6 years, the interest at the rate of like 18%, if the interest is calculated over a period of 6 years, itself the interest goes to 100%. And there are licenses which are pending, which are issued in the year 2008, 2010. So it's more than 12, 13, 14, 15 years are lapsed, and there are no export obligations which are getting fulfilled. And because of this, interest plus penalties, the amount of duty saved goes, sorry, the amount of penalty, interest, and the duty goes more than the cost of machine. So government has introduced this scheme where the interest is capped at 100%. There are no penalties, nothing. So anyone who has imported and has not completed the export obligation, they can make an application to DGFT before 30th June 2023 and make a payment of duty along with the interest before 30th September 2023. In that case, they are eligible for these schemes, and the interest is capped only to the tune of 100%. Now, coming to the last couple of 2-3 slides of my presentations. So, importance of the BRC. So, level this is something which is one needs to understand very carefully. Making an export is not all done. The one needs to get the foreign currency realization. So if you have exported, if you have moved the material from India to, let's say, London, that does not mean the export is completed. Export gets completed only when the Indian government or you receive money in convertible foreign currency. So if you are not receiving the money, in that case it is not export. Though it qualifies for the export, but technically there is no money coming in, that it will not qualify for the purpose of exports. So BRC is a document, that is bank realization certificate is a document which proves that the money is realized against your exports. So BRC certificate, which is a proof of export realization. BRC is issued by the banks based on the realization of the payment against export, and it is electronically done based on the every shipping bill. So whatever the export which you have made, you can submit that to the bank, and then the bank will ensure the appropriate, once the money is realized against that particular shipping bill, appropriate BRC would be issued to you in due course of time. One needs to understand the EDPMS and IDPMS mechanism. So EDPMS is electronic data management and processing system. So it is an integration of all data between export house, that is customs, RBI, AD Bank, and you. So everyone is on the same platform. So you are able to view what has been exported. Your bank is able to view what has been exported. Your RBI is able to view what is exported. Customs is able to view what is exported. And all these are important for the purpose of realization of money as well. So it is just not the export. One needs to ensure the money is also getting realized. So government has developed a mechanism. Once you have exported through the customs will communicate, will put in all data in their system. That will get communicated to RBI and your AD Bank. AD Bank is authorized dealer bank. So once the material is exported, automatically the one particular number, the shipping bill number gets generated, and the shipping bill number with amount gets communicated to the AD Bank. Then AD Bank, it becomes a AD Bank's responsibility to ensure that money is realized. So once the export is done, the AD Bank comes to know that you have made an export, and then they will start following up with you. Where is the money? You have not received money against this particular consignment. If this particular shipping bill, if the money is not realized, in that case they'll ask you to follow up your customer, ensure the money is realized. If money is not getting realized, then they'll ask you various reasons why the money is not getting realized. If money is not getting realized, you will have to write it off in your books of accounts. Then there are various permissions which are required to be taken from RBI before writing it off in your books of accounts. Any export receivable or payable cannot be written off or written back so easily in your books of accounts. There are some permissions which are required from RBI before writing it off. So EDPMS and EDPMS is the data integration between all of these entities, where AD Bank is responsible for realization of money, and AD Bank will always chase you to ensure the money gets realized to your account. Then there is something called RCMC, Registration Cum Membership Certificate. So it is granted by EPCs, that is Export Promotion Councils, on applications. It is mandatory document to claim any benefits under the or any concession under the foreign policy. It is also mandatory authorization for the import-export except items are listed as restricted item. So anyone who wants to export item which are restricted, likewise I said there are like permissions of the licenses needs to be issued. So if one needs to apply for license under that scheme, so one should have a RCMC in place. So there are industry specific licenses are there. So like if there are engineering exports are happening, if you're into engineering product, then you are required to get the engineering export promotion council certificate. If you're into chemical or the similar product, then you can obtain the engineering export promotion council certificate. So every industry specific, there are export councils, and you're required to take the benefit from respective councils as such. Then there is something called bonded manufacturing. This is a new scheme which was introduced in 2019 by the government, where one can import the raw material as well as capital goods without payment of duty and by customs. Well, this is not for part of foreign trade policy, which is something different than foreign trade policy, but one should be aware of it. So as per this policy, you can import raw material or capital goods without payment of duty, provided you import that in a bonded premises. So one needs to get the existing or new manufacturing unit registered with the customs authority, like this is an area which is bonded, uh, and then make an application to government, customs authority, that you are planning to import a particular raw material or capital goods in that bonded premises. So anything which is imported in that bonded premises is eligible for the exemption. So once if that is eligible for exemption, what is the condition for payment of duty? If you are able to export that product which is getting manufactured in your premises outside India, then there are no duty is required to be paid. However, the moment you pay the duty for the domain, sorry, the moment you clear the goods or the sell these goods within India, then you are required to make a payment of duty. So likewise, in case of advance authorization or EPCG license, when you are not sure about whether you have any export orders or no, in that case, it is very challenging to conclude whether you want to take the material under advance authorization scheme or EPCG scheme. If you have a confirm order, you can go under that scheme. But if you don't have a confirm order, you don't know at the time of import whether you'll be able to export or not, then you can import the material, raw material, or the capital goods under this scheme. So this was introduced in 2019, but because of COVID, it didn't get the sufficient marketing was not being done. But yes, this is a very innovative scheme where one can pay the duty only in case the material, manufactured material, is getting cleared for the domestic consumption. Otherwise, you are eligible for zero duty. Without payment of duty, you can import. And if you are into export of the product, you are not even required to consider this as a product. Well, this is something which I thought I should share my thoughts about my presentation about the foreign trade policy. If you have any concern, any queries, anything which you have, you can. I'm open to answer all these questions.
Thank you, sir, for such an amazing session. I hope everyone is clear about how foreign trade policy works, what government aims about the development of the country. I will ask the participant to raise the hand if they have any doubts regarding the session. Kindly please ask the question to sir.
I think Anuj Bhamre is there. He has some query. Yes,
Please
Anuj.
unmute yourself.
Hello, am I audible?
Yes.
Hello. So first of all, thank you, sir. It was a really informative session. So I had a doubt. Somewhere you spoke about a BRC. So I wanted to ask, what is the difference between BRC and FIRC?
So FIRC is just a document which says that it is a foreign inward remittance certificate, which has not mapped with any specific invoice, whereas BRC is mapped with the shipping bills. So it is against which in which shipping bill you have received a material that gets addressed here. But in case of FIRC, there are no mechanism how you can correlate against which invoice you have received. It is just a certificate that you have received money in foreign currency. There is no invoice-based mechanism. There is no invoice specifically mentioned against which invoice you have received money. Whereas BRC helps you realizing against which all shipping bills the BRC is issued. The BRC is post facto of the FIRC. FIRC is a primary document whereas the BRC is the ultimate document which based on which government comes to know that this is you have realized all your money.
Okay, thank you, sir.
Urmil, can you please unmute yourself to ask the doubt?
Hello. Sir, I have
Yes.
a doubt regarding the bonded manufacturing. So you said that if the company is not sure whether the product that they are importing that is going to be exported. So major concern is that every company nowadays, they don't know that the product is getting exported. So can you just briefly explain that in bonded manufacturing scheme, what are the compliances that we need to look out for?
So in case of bonded manufacturing, it is a scheme which is specifically designed for a kind of companies who are not very sure about at the time of import.
Yes.
So once you import a raw material or capital goods in your premises, you need to keep that in a segregated warehouse or the segregated place, not the warehouse, segregated place where you can easily identify your domestic raw material, domestically procured machines, and the imported raw material and imported procured machine. So any given point in time, if any government authorities come or any customs authorities come, you are required to present to them that this is a particular machine which is which is imported without payment of duty. Now you are required to maintain the register for that as well. There are two register called annexure A and annexure B of the form A, form B. There are two kind of register. One needs to maintain for the all the material which is coming as a raw material and all the material which is coming as a capital goods. And the processed manufactured based on using this machine or this raw material, what product you have manufactured and which is getting further exported or further getting sold, that data needs to be maintained. So the moment it is exported, no duty is payable because government got the export completed for it. But if it is for the domestic consumption, government asks you to make a payment of a duty because that is the payment of duty which they would have otherwise got.
Okay. Okay, sir, I have one more question, but it is related to EOU. Can I ask that?
Yes, please. If I'm able to, I'll try and address that.
So it was a situation wherein there is an LUT, letter of undertaking, wherein there are specific ITC codes, Indian Trade Clarification codes, right? So the list of so I'm not sure whether the materials that a company can import should be all written in the LUT. So there are list of items that they can import, right? So I am not sure whether the company can import the products that is not listed in the LUT. Can they do it? Because I'm not able to get that.
So as per UU, if that material is not mentioned, uh, and if ultimately if that material is getting used for the export product, there are chances like over a period of time the product get evolved where you expected X product to be attached to this, but over a period of time technology evolved and instead of X product, Y product can be used for the export or for the purpose of manufacturing. So that is very well possible, but you need to ensure that you need to prove in case of scrutinies that this material which was imported is used for the purpose of exports which were performed.
Okay. Okay, sir. Thank you so much.
Any more doubts, guys? Please feel free to
Uh,
ask.
Hello. Yes,
Yes,
I'm audible.
yes, you are audible.
Okay. So, sir, it's not a doubt, but एक like policy के बारे में एक सुना है कि this policy does not contain any sunset clause. So, like, what is first of all, what is sunset clause was a question, and also, if like sunset clause, does this policy does not have any kind of due date or and if it's there, so why this policy does not have any kind of due date?
So, well, government earlier policy, earlier every 5 years the policy used to be framed and policy used to be documented and were issued. But however, over a period of time, government realized that the frequent changes in the policies results into uh, policy implementation challenges, because there are transitions needs to be considered. There are past period, future period needs to be accommodated. So government said nothing. We will continue with the policy for a long period. There are no clauses, sunset clause to this policy. This is a continued policy unless otherwise specifically notified by the government that this policy will end on a particular day or the particular given moment. All otherwise, government is likely to continue this for a long time. Government is considering to amend this policy as and when required, as per the requirements of the trade and trading felicitations. So government will decide based on interaction with all the authorities, and will keep on amending this policy as and when required.
Yes, sir. Got it. Thank you, sir.
We will just wait for a few minutes so that if anyone has the doubt, he can ask you, sir.
Aram, please cross-check with the Q&A tab if any questions are there.
Yes, I'm checking. Since there are no doubts and questions left, so I would request Mr. Madhvik Shah, the Secretary of Pune Vikasa, to give present vote of thanks to Shailesh, sir.
I think there is someone has raised a hand. I'm not sure.
No, Urmil. Okay. Urmil, can you please unmute
yes.
yourself?
Yes. So in case of merchanting trade, so what kind of benefits can a company can get?
So merchanting trade, it is a simple process. There are no benefits as such, where one can, instead of just taking in commission, you can hide your price, at what price you have procured, at what price you are selling this product to customer. All this can be hidden from the end customer. So you can just like bill to ship to transactions are there, where you send your own invoice to ultimate buyer instead of sending an invoice from your vendor. So it is always better to hide your identity. Otherwise, next time the Singapore person will directly buy from the London person, you will end up your margins.
Okay. Got it, sir. Thank you.
Any more doubts? Anyone? No doubts. Okay. So finally heading toward the last few minutes. Madhvik, can you please give a vote of thanks?
Great session, sir. I would like to thank CS Shailesh Rathi sir for such an amazing session on key highlights of foreign trade policy 2023. Sir rightly stated and explained the importance of import-export code, importance of capacity building at micro level, logic behind export obligations, importance of EBRC, and many more highlights of foreign trade policy 2023. I would like to appreciate the active participation of all students. I can definitely say there will be many takeaways related to today's topic for all the participants. I would also thank to all the CASAs for their participation and support for today's session. I am grateful to Ahmednagar, Akola, Anand, Chhatrapati Sambhajinagar, Dhule, Goa, Jalgaon, Jamnagar, Nanded, Navsari, Navi Mumbai, Pimpri Chinchwad, Sangli, Satara, Surat, Vadodara branches of Vikasa and Cuttack branch of Vikasa. I also appreciate efforts of Team Pune Vikasa and our respected chairman of Pune Vikasa, CA Chairman Sir, CA Sachin Chairman Sir, CA Sachin Minyar Sir. I finally thank to the technical team and support staff of Pune branch for such a great arrangement. I now declare off today's session. Let's sign off for today. मिलते हैं ऐसे ही अगले इवेंट में. Thank you, Madhvik Rahul Shah, Secretary Pune Vikasa.
Thank you.